Good afternoon, everybody, and thank you for joining us this afternoon to learn about governance and financial skills for non-financial people. We're going to be hearing today from Derek again. As you all have probably heard by now, Derek has a lot of experience in both the non-for-profit space, as well as the for-profit space. He's got a series of qualifications in governance as well as finance, or accounting as well. So he's got all of the right qualifications to teach us today about some of the things that can be really confusing, and some of the things that are really important to be across when you're either a director or a manager in the not-for-profit space. So I will start this session by acknowledging the traditional owners, respectfully acknowledging the traditional custodians of the land on which we work and meet. I'm joining you today from the Turrbal and Yagara land, and I'd like to recognise their continuing connection to land, sea, community and culture. And I would pay my respects to elders past, present and emerging. And we're going to have a session. It's about 1 hour. It's not a lot of time for us to cover a big topic, but I think you'll find it really helpful and get across some terms that are good to know about when we're doing our work. So I will hand over to Derek.
Thanks, Hannah. Good afternoon, everybody. Good to see you again for our fourth webinar in this governance series. So as Anna mentioned, we're off today to talk about finance, particularly for those that don't have a financial background. And in particular, we've in the past 3 webinars, we've talked specifically to directors, but this time we're also going to talk about managers as well, because I think there might be some managers on our webinar today. So, and all this stuff is equally applicable and important. So let's get going with that. So this is our 4th webinar. We have 2 more to come in this series, one in legal, which will be fun, and one in strategy and risk. So let's get into this one. Before we get into it though, I just want to talk about what we're trying to achieve here in this next hour, and perhaps more importantly, what we can't achieve. So non-objective. So the first thing is, we're not about to, in an hour, turn anyone into being an accountant, and nor are we able in an hour to make you financially literate. In other words, to be strong enough in an hour to be comfortable to sit on a board from a respect of finance. But this is a start, and what we're hoping to do is raise your awareness about the need to be financially literate when you're on a board or when you're a manager, demystify some terms, because like all professional areas, you know, accounting is full of its own terms, its own language, and that can be a bit daunting at times. We're going to point you in the direction of things you need to know, the important things you need to know to be able to accomplish your duties as a director that we've discussed in the previous 3 webinars. And also from this webinar, what things can you do to go and improve or increase your financial literacy, either as a director or as a manager. So that's what we're trying to achieve today. And so, as I said, this is important to say, we're not about to turn people into accountants. This is just a start. Why are we doing this? Well, particularly in the not-for-profit space, many directors believe that because on the board or in the organisation, it contains members who come from a financial background. In other words, there are other people on the board who are accountants or finance people, or that the organisation has a CFO or a finance director, or, you know, or that they have external auditors, and bigger not-for-profits must have external auditors. And so there is too often, the assumption that those people can deal with the numbers. I'm here on the board for other reasons. Perhaps I'm here because of my community connections. Perhaps I'm here because I'm an expert in clinical areas. Perhaps I'm here because have another functional area. Maybe I'm a marketing specialist or something. But however, as we have discussed, and I'm just taking you back to the previous couple of webinars, directors have what is called the duties of care and diligence. And so with respect to that, it is that all directors individually must take reasonable actions to ensure they're fulfilling their duties of care and diligence. And I've highlighted a few things here in different colors. Hope I haven't got anybody with color blindness here and mixed up the colors. But in particular, part of the core obligations of directors are to maintain familiarity with the company's financial position. So it's not good enough to leave it to somebody else to worry about that side of things. This includes reading the financial statements, the board papers, asking questions, and making your own inquiries where appropriate. Remember from our previous webinars, directors are individually accountable and have individual duties and responsibilities, and indeed liabilities for this area in particular. So it demands a level of financial literacy. And if you remember a couple of webinars ago, we gave you a case study around the big company Centro, whose directors got themselves into a bit of trouble with the courts because they believed they could just simply rely on other people to have that level of knowledge on the board. And the judge said that's no excuse. As a director on a board, you need to understand the basic concepts of finance and accounting of your organisation. They must also have a reasonably informed opinion of the company's solvency position and its financial capacity. And we're going to talk towards the end of here about solvency and what that means. And that's probably the most important part of this whole webinar, and the whole areas of duties of care and diligence is around that of solvency. So this requires directors to critically analyse and employ detailed attention to matters that come before them and not rely on others or simply follow the crowd. And so others, in the case of finance and accounting, are your auditors, your CFO, your financial director, your accounting department, or other directors, perhaps, who have those skills in accounting and finance. So what we're going to cover today is we're going to just clear up some terms here. The term accounting, finance, and economics are often intertwined and get mixed up. So we're going to be clear on what those mean, just so that you understand when these terms come up exactly what they mean. We're going to look at some financial statements, the three basic core statements of the organisation that all directors need to have some level of familiarity with. We're going to talk about budgets, the financial reporting requirements of a not-for-profit, thing called director's declaration, which is directly connected to finance and financial reporting, particularly if you're in a larger not-for-profit that is a company limited by guarantee. And with that, we're going to talk about internal controls and leading straight from internal controls into auditors and audits, what that means. And finally, solvency, and then talk about, well, where do we go to from here? So from this webinar, where can you go to be in a better position to look at the finances of your not-for-profit? So accounting, finance, and economics. And I'll just correct Anna on one point. I'm not an accountant, but I am a finance person. So it's a little bit different. Okay. So when we talk about accounting and accountants, what they do is they keep score. So they generally look at the past. They generally look at how has the organization has performed and produce the statements so that that reporting can be properly understood. Or in the case of companies, not-for-profits, public companies, declared, if you like, to the public. So they're all about making sure the numbers line up and that we're reporting it properly and accounting for things. So it's very rigid. There's lots of rules. There's some abbreviations there. There's GAAP, which is the General Accepted Accounting Principles. ATO, the Australian Tax Office, has its own rules around tax. The Australian Accounting Standards Board defines how numbers and accounting is presented, and IFRS, which is International Financial Reporting Standards. All these things influence the way the numbers are presented, because we can, without that, it can get a bit creative in terms of how numbers are presented. And of course, we have to be obviously here, but very much play by the rules on this. Finance is a bit different. Finance supports decision-making. Finance generally looks into the future, is forward-looking, perhaps more flexible. It's more about, decision-making. It's more about should we spend money here, there, or everywhere else? Where should we spend our money? How do we raise our money? Do we borrow money? Do we raise money in other ways? If you're a commercial company, do you get money from shareholders? For some, finance is far more interesting than accounting, because it's a little bit more subjective, perhaps, than accounting. And then finally, economics. Economics is somewhat grayer. It looks and searches for cause and effect, and it attempts to predict the future. You'll often see, particularly at the moment, with things like changing interest rates and changes to the cost of living and changes to tax policy and monetary policy and fiscal policy and all those types of things. The economists are here trying to predict the future, and that's what economists do. And they also try to link that to society. What are people going to spend? Where are they going to spend? Are they going to buy new homes? Are they going to buy cars? What's the price of fuel? What's the price of grocery? How are they going to spend, and how is it going to change things? So if we look at accounting, it's somewhat very explicit, very black and white. By the time we pass through finance and get down to economics, it's very implicit and perhaps a bit grey or very grey. Okay. So in any organisation, commercial or not-for-profit, we have three financial statements that directors and managers need to be across. Firstly, we have the income statement. In commercial terms, it's often referred to as the P&L, or profit and loss. It shows the performance of the business. It, in many respects, looks at the financial efficiencies of the organisation, what money it received and what money it spent. It's a very simple maths here. It summarises your income, revenue, sales, and your costs and expenses. And very simply, revenue less the costs will produce either a surplus, which in commercial terms is often called a profit, or a loss, which in not-for-profit terms is called a deficit. And then we usually compare the income statement against the budget, which we're going to talk about today, and perform and how for the same period last year. So if we're looking at the income statement for the month of May, it's often compared to the same period last year, just to see how things have changed. Then we move on to the balance sheet, sometimes called the statement of financial position. And organisations, commercial and not-for-profit, have balance sheets. In fact, an individual person, a bank, if you're applying for a loan, may ask for your statement of financial position, and they're effectively asking you for a balance sheet. And what is that? It is basically showing the difference between what you own and what you owe. So what you own are known as assets, what you owe is known as liabilities. It results in what is called net assets. In commercial terms, you would hear of the term equity. Equity doesn't really exist in the not-for-profit space because we don't have owners, right? So what we have are net assets generally. A balance sheet is usually shown in a specific point in time, whereas an income statement is a period. So it might be from the 1st of July, 21 to the 30th of June, 22. That might show the profit and loss for that period. Or it might be a month, from the first of the month to the last of the month. A balance sheet shows the strength of the assets and liabilities at a particular point in time. So the balance sheet today won't be very different to the balance sheet tomorrow. Okay, so it doesn't generally show a period of time. It generally shows a point in time. And then finally, we have the cash flow. It very simply shows the cash that comes in and the cash that goes out. And whenever we talk about cash flow, we always talk about the bank accounts. What is the actual physical cash that's in the bank? How much came in and how much went out and where did it go? It results in what is called a net cash position. And like the income statement, is generally shown from a period. So from the start, so the first of the year to the end of the year, first of the quarter to the last day of the quarter, first of the month to the last day of the month. That net cash position is often called liquidity. When you hear people talk of liquidity, they're talking about cash, liquid cash, actual money that can be used. It is often also referred to as value. When we create cash, we're creating value, or sometimes we're destroying value when we have cash. We can show it as a statement of cash flow, which generally looks in the past. And more importantly, as a board in particular, boards look at a cash flow forecast where they try to look at what's the cash position going to be next week, next month, next quarter, next year. So it's known as a cash flow forecast. And we're going to talk about these three statements, and cash in particular. You may think, what's the difference between cash and an income statement? Well, in the income statement and the balance sheet, there are often things that are what are called non-cash. They're not actually cash, they're accounting. They're the way we're accounting for the value of assets, for example. And that doesn't necessarily translate to cash coming in and out of the bank. So cash is real money, folks. It really represents, what the business is doing with respect to its solvency. So we're going to talk about that going forward. So just as an example, here is a profit and loss or an income statement for a mythical company called Acme Settlement Limited. It is the income statement for the 30th of June, 2021. So it is showing down the side is all our different line items. Up the top here, if you can follow my mouse, these lines here are the income lines. This is money that came in. This is revenue. So Acme received 21,000 from grant income, 117,000 worth of contract income, donations of 10,000, and it runs a social enterprise, which generated $15,000 worth of sales, a total of $163,000. Because it has a social enterprise, it also sold stock. So we have this thing called cost of goods sold. So that's the stock that it sold. But then underneath that, all these things here are expense items. These are the costs required to run the business. Everything from accountant's bill to air tickets, asset fees, bank fees, IT, whole range of different things here, subscriptions, printing, marketing, and so on. And if there was labor, which Susan showed, wages and salaries down the bottom here at $155,000. In this particular month of Acme Settlement, there was a bit of a problem in that it sold. Could you say that again? Sorry, that's my Siri going off on my watch. Sorry about that. So $163,000 worth of income. It spent a total of $228,000, which meant that it lost $76,000. It had a deficit of $76,000. In its budget, in its plan, it planned to do $459,000 in June, and it planned to only spend $221,000. Consequently, it was supposed to make a profit in June of $217,000. So there's a bit of a problem in June. And so questions for the board or management is what happened here? And it appears at the top that perhaps it didn't get the sales that it thought it would get or planned to get in its budget. And then it compares that for the same period last year, so June 2020. And here is a running total. This is the year to date. So this is where we're traveling so far in the year. And it looks like for the year that Acme Settlement is doing quite well. It's made $1.749 million from a total sales of $4.6 million. Okay. So an income statement of profit and loss summarizes income and expenses. It is generally a month, quarter, or year. You don't generally have an income statement for a week, but you can do. You can do. There's nothing stopping you doing that, but you don't generally do that. The maths is simple. Income received, less cost of goods sold if you sold any stock, if you've got a social enterprise or something like that. That equals gross profit. We take away from gross profit the expenses or the costs of doing business, and the maths come up then with a surplus, so a profit or a deficit. Okay, so that's the income statement. So it measures on a month-by-month basis, generally, the efficiency of the business. It's received money and it's spent money to generate that money and has generated a profit, or hopefully not a loss. Some things you should consider when you're on the board. It is incorrect to assume that because you're a not-for-profit that you cannot produce a surplus or a profit. People believe that because you're not for profit, you can't produce a profit, and that's not true. The only difference between a not-for-profit and a commercial organisation is a not-for-profit can't distribute that profit back to its members. A commercial organisation distributes the profit back to the owners of the company. You can't do that in a not-for-profit. That's the only difference. So the objective should be to make a profit. So it's important for not-for-profits to generate a surplus, because what they do with it is they redirect that surplus back to the development of its services and capabilities to support it delivering on its social purpose. Okay, that's the only difference. So instead of sending the money, the profit back to the owners, it sends it back into redeveloping and producing a sustainable level of service against its social purpose. So not-for-profits also have the issue of grant funding. So when we say grant funding, it's where a not-for-profit receives a big chunk of money in one hit, might receive $500,000 to deliver on a grant. And then it has then, say, 12 months or 2 years to deliver against that grant. So in 1 month, it might receive $500,000, but then it spends against that for the next 12 months or the period of the grant. How that's treated, because obviously you have a really big profitable month the first month, and then every month after that can be producing a surplus. So how that's treated is something we'll talk about on the balance sheet. Okay. Important point when looking at the income statement: large amounts of short-term income can distort the view. So in other words, sales can make organizations feel they're doing very well, but really they need to be concerned and look at what is the underlying purpose of the organization. Okay, so don't be flattered by receiving high grants or contracts. That's great, but then you've got to be concerned about how they're delivered efficiently. The balance sheet or income, a statement of financial position, summarizes what the business owns and what it owes. It's a point in time, that is just on a day. So this particular balance sheet was at 30th of June 2021 for Acme Settlement. Up the top here lists all our assets, and here lists our liabilities. Assets less liabilities equal net assets. We still show equity and things like that, but they're not really that important on a not-for-profit. Okay, very simple maths. Assets minus liabilities equal net assets or equity. Okay, we have two types of assets: current assets. So these are assets that will be there for the next 12 months. So cash in the bank, that will change within 12 months, one would hope. Accounts receivable, this is people that owe the company money, which is not cash, right? That's money that's coming in, that's an asset. So that the organization has billed its clients for that money, but it hasn't received it yet. If it had received it, there'd be more money in the bank here. Non-current assets, these are assets that will survive the next 12 months. So things like property and computers and motor vehicles and plant and equipment. So these things will be around with the company for some time. The question with non-current assets is, what are they worth? you buy a car today, and we all know when we buy a car, we drive it off the lot, straight away with 30, the value of it's probably deteriorated by 30%. Perhaps not now during COVID, because cars are worth a lot more because they're hard to get. But typically you drive it off the lot and it's not worth what you paid for it. And that change in value is what we call depreciation. So what these are worth is a big question for directors. And then we have our liabilities, what we owe. Accounts payable, this is money that we owe people. So people have sent us bills and we owed it, we haven't paid it yet. Credit cards, debt, loans, those types of things. Two types of liabilities. Current liabilities, these are liabilities that are due to be paid within the next 12 months. Very important point for directors to watch is current liabilities. Non-current liabilities, these are liabilities that survive the next 12 months. So this might be a loan at the bank that's not due to be paid for 10 years, okay? It's paid down progressively, say every month, and that liability every month changes, but it's not due to be fully repaid for over 12 months. Long service leave, okay? So we have staff, they're employed by us. At some point in the future, we will owe them their long service leave. That is a liability into the future. It's not cash, is it? It's not something we have to pay tomorrow. It's something that we won't pay in future years, okay? But that is a non-current liability. So some questions board members should ask, some things to consider as a director. With respect to assets, do they exist? Yeah, we've got a lot of assets. Computers on the balance sheet, where are they? Do they actually exist? So it's important we have things like asset registers that keep track of where they are and what state they're in. What are they worth? A property today, valued today, is it we value it today, we value it in 2 years' time, perhaps. What's it worth? Because that's what's on the balance sheet is reflected in the last time a valuation was done. What are the depreciation and impairment issues? So as I said, you drive a car off the lot, it loses value, that's called depreciation. And if the balance sheet is showing an asset worth more than what it really is, then we have to make an adjustment to that, and that's called an impairment. And that will affect, that goes across to the profit and loss as an expense, okay? So that is a loss, okay? Liabilities, recognition of work or monies received in advance. Now, this is what I was talking about before. Not-for-profits receive a grant. Great, we've received $500,000 in May. We have to deliver on that grant for the next 12 months. So we have liabilities against that grant. We have to deliver on that. And that is often referred to referred to on the balance sheet in liabilities as it might be called monies received in advance. It could be given another term by accountabilities in terms of unrecognized liabilities or those types of terms. That refers to that work that is still yet to be delivered, yet we've received the money in advance. What is the impact of the current liabilities to be paid in 12 months versus the non-current liabilities? So do we have a debt that's due to be repaid in the next 12 months? And is that being shown properly on the balance sheet? Because if we can't pay the debt, we can't pay our bills, therefore we're insolvent. And so this issue of what the current liabilities are very important. And one really big current liability that most organizations face is paying staff. Can we meet the payroll this month, next month, future months? Now starting to look at issues of solvency. Have we provided enough provisions? For example, staff long service leave. So that is a non-current liability into the future. Staff annual leave. So what's the leave that staff are due to take this year? And the problem is if we don't have staff taking that leave, we accrue for it today and they don't take it for 5 years. In 5 years, they might be paid more than they are today. And so that liability doesn't cover that, if that makes any sense to you. An important point with the balance sheet, the current assets should cover the current liabilities by 1.5 times. That's the benchmark. So your current assets should be 1.5 times more than the current liabilities. Just something to take home and look at your particular financials on your particular board. Cash flows. As I mentioned before, a cash flow can be shown as a statement or as a forecast. This is probably the most important financial statement that a director needs to look at. It is a summary of the cash coming in, shown at the top, grants received, contracts received, social enterprise receipts. So this is money received with money going out. Now, the one I'm showing you here is not a statement because I think it's more useful to look at cash flow forecast, because a forecast allows us to predict down the bottom here. So here's the cash coming in, cash coming out. The difference is net cash down here. And numbers in brackets in finance and accounting usually mean a surplus or a deficit or a negative number. And so we can see some negatives down here where our net cash flow is actually gone negative. Okay, whenever we talk about cash flows, we always record it with respect to the bank balance. It'll always be on a cash flow statement will be the bank balance, starting and finishing. Because this is real money, folks. This is the real money that exists in the bank at the time, okay? And if we suddenly have to pay a debt, if we have to pay staff next week, it's going to come out of that cash, okay? Simple maths, cash in less cash out equals net cash. Okay, and then we adjust the cash balance at the bank to reflect what the cash is at any given moment. Okay, so this forecast is something most boards, most directors should ask for. What is our cash flow forecast? You might be just forecasting for the next month. You might forecast for the next quarter or maybe for the next year. Obviously, the further out a forecast goes, the more kind of grey and flexible it is. But certainly forecasting next month or quarter should be reasonably solid. And the accounting team will come back and actually look at what are the bills that we have to pay, what is the money we expect to come in. Okay. Important cash flow discussions. Generally, an organization can generate cash in 3 ways. It can from its investments. If it has been lucky enough to have a lot of money and invests in the bank, it might be receiving interest payments from term deposits and things. So that's money coming back. It might do it from the sale of assets. It might have property that it sells. So when it sells it, it receives money back. And then thirdly, and most importantly, it receives it from its operation. So in other words, from the profit and loss. Yeah. Income less expenses produces a surplus. That produces a cash amount. Now that number can be different. The cash received and the surplus in the income statement can actually be different, okay? And it's really important that the surplus cash from the operation should be more than the net surplus on the income statement. Yeah. Now, the income statement includes non-cash expense items as well. But it's important as a director that your surplus cash from the operation, and it will be shown in your statements, the cash from the operation should be more than the net surplus from the income statement. If you're generating cash from investments and sale of assets, that necessarily isn't long-term or sustainable. Or if you have a really big bank account and you're taking money and drawing out of that bank account to make up for deficits in your income statement, eventually that will be a problem because you will run out of money. So it's important as a rule of thumb that directors search for the surplus cash from the operation be more than the net surplus shown on the income statement. This is known as self-generation. This is the reality test, okay? All right, so taking money out of the bank to top up, to pay staff, or taking it from investments or selling assets, etc., is short-term. The long-term sustainability of the organization is cash from its operation. Okay, this is a key indicator with regard to solvency. An important point, an organisation can produce a surplus and still go broke. So we can produce a surplus on the income statement, which is on paper, but if it doesn't have the physical cash in the bank to pay staff next week, it could go broke. Okay, and it has happened. Which leads to budgets. You know, budgets, many not-for-profits don't do budgets, many do. And really, if you can nail a budget and get it done really, really well, the benefits of doing a budget far outweigh the challenges in doing one. Now, budgets are predicting the future, there's no question, month by month. And typically when we budget on the income statement, okay? We budget for income, which is very difficult at times to predict how much money you're going to get in. We budget for expenses, which is really easy because it's really easy to predict how much money we want to spend. And we budget for capital, so capital purchases. If we want to buy assets, you know, that's called capital budgeting, okay? If you can get budgets, they're a great way to measure performance and measure the efficiency of the organisation, okay? But important point, particularly for managers, budgets are not real money, okay? Because it's in your budget doesn't mean you can spend it, okay? When we do a budget, the accounts team don't put, you know, we're going to do Anna's budget today, okay? We don't put Anna's budget away in a safe somewhere and so that's ready for her to spend. It doesn't work like that. The budget is based upon achieving the income and achieving the expenses and achieving the capital as planned. This brings us back to the delegations policy that we talked about a few webinars ago, okay? It is, if you like, the relationship defined in black and white between the board and management. So the board delegate some or all of its powers to management. So remember, under our fiduciary relationship, the board has the power to run the organisation and it delegates it, usually through the senior manager, if it's the CEO, and it delegates it to that person. And that's found in the delegations policy. And within the delegations policy, it has what is called the limits of authority. So now a little example down here, it shows that to spend capital expenditure that has been budgeted, a senior manager in this organisation can spend up to $10,000. The CEO can sign off between $10,000 and $100,000, and the board must sign off anything over $100,000 in that category. And we can define that for all the categories, whether it's a travel budget, whether it's your advertising budget, whether it's your events budget, whether it is writing off bad debts, whether it's a whole range of different things can be in the delegations of authority. But it's an important point, even though you have budgeted for something, a manager still needs to go back to the delegations policy to decide or to determine whether they can just spend that money or must seek a higher level of approval from a senior manager, CEO, or the board. I hope I'm being clear on that for managers and for board members. The sorts of decisions we find in the delegations of authority policy: operating expenses, as shown there, marketing, advertising, travel, attending conferences, freight, utilities, donations, etc. Capital, such as property, plant and equipment, motor vehicles, computers, the engagement of consultants, sometimes by type, sometimes it can go down to say, you know, a HR consultant, usually in recruiting, can we engage one of those? An IT consultant, management consulting, staff hiring and firing, the ability to enter into leases, property, motor vehicles, plant and equipment, or even trade accounts with your local Bunnings should be within the delegations policy. A whole range of different issues can be defined in the delegations policy. It's up to the board to determine how far down they want to go to in defining this, but they must have a delegations of authority policy, and it must have what the limits are in that policy. So moving on to the financial reporting requirements for a not-for-profit. We've talked about this before, but essentially if you're a small not-for-profit less than $250,000, you just have to provide an information statement of your programs and basic financials, really basic financials. You can provide optionally a financial statement to the ACNC if you wish. If you are a medium, that is above 250K to $1 million, then you must submit what is called a review audited financial statement. So that's not a full audit, it's what's called a review. And this must be done by an external auditor, so somebody who is independent and properly appointed by the board. If you're larger, greater than $1 million, or are a company limited by guarantee, governed by ASIC, then you should submit an audited financial statement. So that is a full audit done by external auditors. The Corporations Act also is helpful in terms of it doesn't require companies limited by guarantee that are less than $1 million to have to put a full set of financials to the ASIC. Okay. If you are a company limited by guarantee, under the Corporations Act, directors have to sign off a declaration every year. This declaration says whether in the director's opinion, the financial statements and notes to the account are drawn up in compliance with accounting standards. Okay. 2, whether in the director's opinion, the financial statements and notes to the accounts are drawn up to give a true and fair view of the financial position of the firm. And 3, whether in the director's opinion, there are reasonable grounds to believe that the company will be able to pay its debts as and when they are due and payable. You are signing these off as individuals, folks, not as a board. And it is where you rely on the auditors or the finance people in your organization or the CFO or other directors that problems start here. You must make your own inquiries. You must read those statements. And there's no such thing in this area as a stupid question. You should raise questions if you're not sure. Go get a second opinion from somebody outside the firm. Ask if you're not sure. But it is very important that you read these before you make this declaration. Okay? Really, really important. So before signing these statements, you should just simply apply the following principles. Be skeptical. Ask questions. There's no defense to say that you didn't know. Okay? Accounting knowledge, you must have a level of financial literacy and basic accounting knowledge. Unfortunately, there's no way of getting around this. Accountability and control, it's up to directors to ensure the executive, that is management, have the systems, protocols, and controls to ensure sound governance. So there's no point in insisting on sound governance, but then not giving the resources to management to achieve that. And culture, directors, as we know, tone from the top, the board has responsibility to drive a culture of compliance within the company and have zero tolerance for things like fraud and theft and those things that unfortunately happen in all organizations from time to time. Okay. Which moves us to internal controls. Internal controls are the rules, policies, and processes that are adopted for the purpose of protecting the assets of the organization. So making sure if we bought a computer that it stays as part of the company's property for its life and doesn't disappear or get lost. Ensuring the financial information is accurate and reliable. It ensures compliance with operational and financial requirements. And it supports achieving the organizational objectives of the company. So what internal controls are, we go back to the delegations of authority, because the auditors will come along and check that who has issued a purchase order to this organization, who's signed that off, and has that been within the delegations of authority. A big area of internal controls are the bank accounts. Generally, it's not left to one person to press the button to pay somebody, even to pay the payroll. It's usually 2 people have to do that and check that. And that's for internal controls. Because obviously, when you're dealing with money and you're dealing with the bank, that is where there can be problems occur. Okay, and so it is up to the rules, policies, and processes set by the board and then by managers to ensure such controls are in place to make sure that the delegations of authority, that policy has been adhered to for these reasons shown on this slide here. Which brings us to auditors and audits and auditors. There are two types of auditors, two types of audits. They are coordinated by the audit committee. Most organisations will have a subcommittee off the board that is the audit committee. Sometimes it includes finance and sometimes it includes risk, but most will have an audit committee. Their job is to work with, in bigger organisations, there will be internal audit. These are people who work in the organisation used to check the internal controls. The audit committee coordinates a plan of audit activities in the organisation, which is signed off by the board or the audit committee. It looks at these controls against the delegations of authority. Then we have external auditors. As we said before, depending on your size, will depend on whether you need to engage external auditors. They review the financials as required by the ACNC and ASIC. It could be a review, it could be a full audit. So one's a light version, one is a full audit where they go through everything. They must be independent. The auditor you can't have for example, a partner in an audit firm being on your board, as an example. They have to be fully independent and they have to be properly appointed. That is usually found in the Constitution. They provide an opinion for the purpose of enhancing the level of confidence in the financial report. An opinion that has to be backed up by your own opinion, your own questions, and your own review. Okay. Which brings us to the most important area of this presentation, which is solvency. All directors, and this doesn't matter whether you're a director of a large company limited by guarantee or a small incorporated association or even unincorporated association. If you're a director or a management committee member, whatever you are, you have a legal duty to prevent trading whilst insolvent. Simply, insolvency is where the organisation is short of cash and cannot pay its debts as and when they fall due. Directors have to remain vigilant for indications of insolvency or decisions that may cause insolvency. So in other words, it's not just whether you're insolvent today, but is this event or this decision that we're going to make pushing us into a position of insolvency? So one event into the future may be a liability going from non-current to current and not having the money to pay that liability. Yeah. So you must read the financial statements and management accounts, and you must obtain professional advice. Some constitutions, some charters of boards actually allow and actually pay, in some cases, for directors to seek external advice on these things. Okay, they allow for it. Obviously bigger ones that can afford that. Okay, but they do everything they can to make sure directors are making their own decisions. Some key questions to ask around solvency. Do we really know when the debts are legally due? So when they're due and when we expect to pay them might be two different things. So do we understand that difference? Do we have sufficient cash to pay the debts when they're due? If not, do we have other cash-like assets such as term deposits that can be withdrawn down to cover the debts when they're due? Can we sell property? Have we formally negotiated longer supply and payment terms that match our normal payment cycle? So if we feel we're in a bit of trouble, can we go to suppliers and say, can we stretch our terms out? And that's usually done with very strong communication. The ATO is one where you can sit down and negotiate your BAS payment and say, can we push this out to help us out here? Do we get regular and accurate cash flow projections? So a cash flow forecast of board meetings. Do we check what happened in reality against the projection at the last board meeting? So it's one thing to have a cash flow forecast produced at this board meeting, at the next board meeting, do we go back and check that that was accurate? Did that happen? Do we have bank facilities that we can draw down if we need them, or other cash guarantee facilities? So do we have some loans that perhaps we can draw down? Do we have lines of credit or something to help us out that we can draw down? And are we at least sure that we are solvent to the next board meeting? Okay. This usually can come by surprise to some directors. Okay. But it is a legal responsibility, okay, to ensure solvency. You cannot trade when you cannot pay your debts. It's illegal. Okay. And technically, and you probably won't, but technically you could go to jail for that. And some directors have. Now, I doubt that the authorities will come after smaller not-for-profits on this issue, but it is still possible. It is still liable. You cannot do it. Okay. So what do we learn? We've learned that budgets are fantasy. They're just a plan. Okay. Just because it's in a budget doesn't mean we can spend it. Okay. Sales or income are flattery. It's great. It's great that we've got this sales coming, but let's not use sales necessarily, to hide, to cover up our sins. Okay. So again, we get a big grant. That's great. We have to deliver on that grant. Okay. What's our cash flow position based on delivery on that grant coming forward? Profit is reality. Okay. So profit, if you're making a profit, you're probably in a good shape. You're probably okay, but it's just reality. And finally, cash is king. It is all about cash in the bank. And do we have cash? And many not-for-profits keep up a big bank account ready for a rainy day. That may not be the best way to use that money. Okay. But I know many not-for-profits do that. Okay. And there's debate whether that is the right thing to do or whether that money should be reinvested back, given that that money as a not-for-profit has come many times from the public domain. Is that the right thing to do with that money? Okay. It's a balance before, being able to cover your non-current liabilities at any given time and also reinvest that cash back into the business to help you achieve your social purpose into the future. So what should you do now? Firstly, ask questions. Question. When you get the financials, read them, ask questions. Do not blindly go with the flow. Yep, the auditors say it's okay, that's okay. You should at least read and ask your questions. Seek some external opinions if you want. Meet with your finance team regularly. As a board member, there should be nothing stopping you with the proper protocols and the proper courtesies of meeting with your finance team to discuss the financial aspects of the organization. And then finally, raise your levels of financial literacy. Remember, you don't need to be an accountant. I know it all sounds scary, and I know that may sound like that's what you need to be on a board. You don't, okay? You can embark yourself on getting full education. You could go get a certificate or a diploma in business or finance or something like that if you wanted to. You get a degree in accounting if you wanted to, but that's several years down the track to do that. You could go to AICD, the Australian Institute of Company Directors. They know the right level to pitch it at, but they can, very expensive way to do that as well, okay? Or you can attend shorter vocational training from a range of providers that do more than our hour webinar. They'll do a day in this area around, finance for non-financial roles. It's a common area of development that is out there available. And even in SETSCoP, we're looking at perhaps doing that, down in the future, doing a full day finance for non-financial training, because this is such an important area for directors and for managers. Informal learning, we have a whole range of SETSCoP business guides on this. You can do your own learning yourself, or you can seek help from some friendly financial literate people that you may know that can give you some coaching around this area, or someone to bounce those questions that you should be raising as your position as a director in a not-for-profit. So that brings us to the end. Our next webinar is the 25th of May, and even, you know, perhaps less sexy area is legal issues in governance. So here we're going to talk about the law. So if you thought today's was dry, you wait to see the next one. But again, this is an important area for directors to have this awareness of. And here we'll be discussing that legal environment with regard to governance. And then we have future webinars on director skills around strategy and risk, and that will perhaps be a little bit more colourful than today's and next month.
Thank you so much, Derek. Thank you for all that information. There's a lot to know, and we have just scratched the surface. However, I think it's really helpful to get a better understanding of some of the terminology, actually see some of those examples, what it looks like, and be able to understand what the different parts of those reports mean. Anyone who has questions is always welcome to contact us. Derek's even happy to have a conversation with any of the associations or groups that have questions that they would like to ask. So feel free to contact us at the secretariat@setscop.org.au email address, and we can connect you with that. We will be making available the PowerPoint PDF and also the recording of this link for all our registrants. So thank you all for joining us, and we'll look forward to seeing you next time. Take care.